This is Chuck Cornell, and I'm the Chuck in the Markets Up Chuck. And today's video was titled Germ Freedom Fighter. And reading an article in Bears magazine over the weekend, I saw an article that talked about how Steris was doing extremely well because of the flu pandemics that were, driving sales. This company basically fights infection and provides sterilization of equipment, and they're essentially in the anti-germ business. But what I found interesting when I actually went through the chart, looking at our fundamental research analyzer tool here, you can see how closely over time stock prices have followed earnings. And I think this is very, very important. And I stress this over and over again, but look how the earnings of Steris rose here, very nicely starting from the period 1993 and, did real well up to 1999. The stock price tracked that. There's obviously volatility in the middle. That's always going to be based on headlines or news. But then notice we had this drop in earnings that went, through 2001 where we hit the recession at that point in time. And, of course, the stock price tracked that. Then we had a nice rally in earnings and, of course, a rally in stock price. Earnings flattened out a little bit for a year or two, and not much happened in stock price. And then we had a nice rally in earnings, and of course the stock price was doing extremely well until the recession hit, and then the stock, fell in value. But if you look at this company, it has very little debt in the balance sheet, pays about a 1.1% dividend yield. You can see that by the blue area. Remember, that always comes out of the earnings line here. If you look at it on a price-to-sales basis, it looks very attractive today relative to, to its normal price. Not necessarily dirt cheap, but cheap. On a forecast-to-earnings basis, it's forecast to continue to grow at 15% a year, and that's about where it's trading, roughly at 15.3 times earnings. That's blended earnings. And then if you look at its track record, since over the past 19 years, the company has clearly outperformed the S&P 500 by almost a 3-to-1 factor. It's compounded compounded return of 15.8% versus only 5.5 for the S&P. So, clearly this has been a good historical company. It seems to be reasonably priced. The recession has given us a little opportunity here. This is one I think you ought to look at, but the main reason for showing this is I wanted you to see how uncanny and how important the relationship of earnings to market price really is. In the long run, stock prices are going to track earnings. This is Chuck Cornell saying thanks for listening, and talk to you again.